Should only take a couple of seconds here. Hi, everyone. This is Shauna, the Tax Goddess. I am super excited because here we are today with the fantastic Rocky Lalvani. And Rocky is a specialist in the profit first methodology. Now, I have been asked this question at least 5 times a week. I swear, ever since the book came out, this profit first and what is profit first and how do I implement profit first? I mean, people really all about profit first. So Tax Goddess is so thrilled to have such a fantastic expert with us. Thank you so much for joining us today, Rocky.
Thank you so much for having me. I'm excited to share and help your audience understand how profit first works.
So let's jump right into it. So give us the definition, because a lot of people have heard the term profit first, but a lot of people haven't. What is profit first and why do I care?
So Profit First is a book written by Mike Michalowicz, and it actually started as a chapter in another book that resonated so much with entrepreneurs. He actually expanded it out into a full book. The backstory behind this, Mike is, he actually did the forensic accounting for Enron. And so he said, yeah, they were guilty. He sold off that company, walked away with, millions of dollars, and said, hey, I'm a real smart business guy. What he was a lucky business guy.
Right place, right time. There we go.
Right place, right time. Quickly blew all that money to the point of, hitting bottom again. And he said, okay, I need to get smarter. I need to make better decisions. And one of those areas that he struggled with was money. And so he said, why are we struggling so much with money? And he said, it's Shauna's fault. I said, what do you mean it's Shauna's fault? Well, Shauna told me that the formula was sales minus expenses equals profit, right? That's the standard formula for
standard accounting.
Right?
Keep my name out of this, Rocky. Honey. I would never say that. Thank you very much. But an accountant told him that this was the formula.
An accountant, right? Well, that's standard accounting practice, right? And where does that leave profit?
At the bottom.
At the bottom, a leftover, right? Hey, when we get to the bottom, after you spend everything, there's a number, right? And, this is what other accountants do to their people that, tax time comes around and they say, congratulations, you were profitable. Here's how much you owe in taxes. The first question the business owner asks is, where is that profit? Now, I'm sure you don't laugh at them like everybody else. And so you spent it.
Yes. Because just because the bottom line profit says profit, that is not your cash, not even close to your cash in many, many, many situations. So,
correct. And so Mike said, let's fix all of this. So he made one little change. Sales minus profit equals expenses. And so we take profit first. And when I say we take profit first, I literally mean we take it out of the bank account and we put it in its own bank account that's labeled profit. And now at the end of the year, there's your profit account. You saw it, you have it. It's real cash that you can spend and use outside the business, right? It doesn't have to be inside the business. And so that is kind of the underlying principle behind this. But there's a whole bunch of behavioral stuff going on to help us as humans maximize our bad habits behind the scenes.
I was supposed to say all that nasty psychology stuff, I'm sure.
It is very, very much so. So one of the reasons this works is something called Parkinson's Law. And I don't know if you're familiar with Parkinson's Law.
Tell me again. Tell me again.
So Parkinson's Law basically says we will use up all the resources allocated to us. So back in school time, right, you had 3 weeks to write a report, right? It took you 3 weeks to write a report, but that's false because you spent the first 2.5 weeks goofing off and then you did it in the last 2 days, right? Well, that's the reality in life too. If somebody comes to you and says, hey, we have a project, it's take 3 weeks, you'll take 3 weeks. If they come to you and say, I need this in 3 hours, you'll get it done in 3 hours. Those same,
you'll have a damn good try.
You'll Absolutely. Have a damn good try. And we'll talk about what a damn good try means in a minute. The same thing happens for money. They come to you, the first thing the salesperson says to you is, what's your budget? Right? And if you tell them 100,000, they're going to have $100,000 sale for you. And if you tell them 10 grand, they'll figure out a way to come in at 10 grand.
Yep.
And they're able to do this. So now everyone's going, how do you do this? This is magic. How can you do something in 3 hours instead of 3 weeks? How do you get something done in 110,000 versus 100,000? And you know this one.
Well,
This
I was
comes
about
back.
to laugh a little bit because, you know, I am a goddess, but there's only so far the magic goes, right? I mean, we have to have systems, people. Systems. This is why Rocky's here. So, go ahead.
So this comes back to the Pareto principle, which is the 80-20 rule, which I'm sure you're all familiar with, which means that 20% of our efforts produce 80% of the results. And if you actually take it one step further, 40% of your efforts give you 96% of your results, which means 60% of the time we're wasting time to get very little results. And that's why Parkinson's law works. And that's how you apply it into here. You get rid of all the wastage, all the junk, and you really squish it down. So you're running a very efficient business at this point. And those are the principles behind it. But we've got to constrain you. So we know that business owners always steal from themselves. They pay themselves last instead of paying themselves first. We keep reinvesting in the business, right? Because that's what we're told to do instead of taking money out.
For many people, this is their baby. And no matter what, I want to see my baby succeed and grow and do whatever it is. But maybe that's not necessarily the best choice. This is great. Yeah.
Your baby business is like your baby child. If you give them too much money, you will spoil them.
I love it. I love it. Okay.
So let's take a step back to the way that the principles work is we create a whole bunch of accounts, right? And it's kind of like Dave Ramsey. Dave Ramsey talked about the envelope system. Other people in that space have talked about the envelope system. We're going to take the envelope system and the principles that are used there and apply them to our business. So we're going to set up basically 5 accounts. The first one is the income account.
Okay.
All your money goes into the income account. This way it's really easy. Yeah. All your sales go into your income account. So this way it's really easy to see how much money came in. Now, I just want you to remember top line is vanity. All right?
Top line is vanity.
Bottom line is sanity. And cash flow is reality. So this is going to show you reality. Right?
Okay.
So all the money comes into our top line, into our vanity income account.
Okay.
And then based on where you are today, you start allocating your money. So a certain percentage goes into your profit account.
Okay.
A certain percentage goes into owner's pay.
Okay. So those are two separate things.
Two separate things, yes.
Owner's pay and profit are two separate
things, yes. The third account is your tax account because not everyone has Shauna the Goddess making sure that you're not paying taxes on your side. So for the rest of you, you have the tax account to pay for the business's taxes. And taxes are the price we pay, right, for being successful. And that's the reality. And there are appropriate ways that I'm sure Shauna will show you how to pay less in taxes. So that's perfectly fine. And then our last account is our operating expenses. And so that is the account that after we've paid everything that's important, we can look at. And what's happened now is we've constrained our spending because most business owners are not accountants. They don't want to be accountants. They don't look at their accounting reports that are weeks old. They look at their bank balance. Now, when you go to look at your bank balance, you look at your operating account bank balance, and that is how much you truly have to spend. And now you can spend.
Now that you've segregated it, that is how much you can truly spend. Because I think one of the major issues is that most business owners have one bank account. So that number of what can I truly spend, as you were saying, the Parkinson's law, right? Anything I see, I can spend. Well, if it's all in one account, great. Look at how much money I have. I could totally spend all of that. Let's go. So basically, let me repeat it back. Let me make sure I understand. Okay. So setting up 5 accounts, right? The first one is all the income. So that's just like a deposit account. That's it. The next one is going to be for owner's profit. Did I get that right? So
It's
profit
the
first.
profit. So your business should pay you a dividend and a profit for all the investment that you put into it.
Equity and everything else. Okay. Then I have my owner's wage. So as if I was paying anybody else to do my job.
Yes, and more.
Yes, and more. Okay. So we're going to go into detail. Yeah.
Yeah. Here's the one thing that's more there. Let's say that you're the business owner and the business pays for your car.
Okay.
And they pay for your annual corporate trip and your cell phone and all these other things. We put that all into owner's pay. And the reason we do this is when you go to sell your business and somebody wants to buy it, it shows them the true value. And it's not hidden anymore. Like it's not buried in these spreadsheets and people are going, I don't believe that.
Yeah.
You can actually see the flow in the bank account and they go, oh, this is really what the company will pay me. This is the benefit to me. I'm going to pay you a lot more for this company.
Got it. Okay, so this is also thinking 5, 10, 15, 20 years down the road of what is my business going to be worth for sale. Awesome. Okay. So income, profit, owner's wage plus owner's benefits, really. Anything owner's benefits. Okay. Then the fourth one.
Tax.
Mm-hmm. Okay, so
your favorite subject.
There we go. Yay. Okay, so number 4 would be tax, right? And so, of course, work with your CPA, work with your tax strategist to make sure you have the right number there. Because if you don't put the right amount into that account, you could have a problem.
Can I tell you a tax story?
Yeah.
So, and I don't know how you do things. So this is not a reflection on you, but most accountants will do quarterlies based on prior year sales.
Yeah. Doesn't quite work.
That
doesn't work.
That's what some people do.
Okay.
So this guy was using profit first, Mike.
Yeah.
He had a blowout year. Like things were phenomenal. Yay. Tax time comes. He doesn't have Shauna, the tax goddess. She calls him up. I've been dreading this call. He's like, what's wrong? You owe a lot in taxes, right? That's the dreaded call from the accountant that you don't want to make and they don't want to receive.
Right.
What usually happens on the other side of the phone when you have to make those calls? Are they screaming?
We don't have to make.
You don't have to make those calls.
And so I don't. But we hear the horror stories. Of course, my CPA told me to pay $50,000 in quarterly, so that's what I paid. And then I had a great year, and so my tax bill was actually $150,000, and I had to write a check on April 15th for $100,000. I was not happy because that money had been allocated to my equipment, the staff, to whatever I was going to do. That money was already allocated. It's a serious problem.
And so what Mike said to his accountant was, how much do I owe? And she said, pretty much $100,000. Mm-hmm. He said, cool, I'll drop off checks tomorrow. And she said, in my 23 years of doing this, nobody has ever said that to me. And he told me, he goes, I actually had more money in my tax account because we had allocated the appropriate percentage and it had built up with the sales. And all of my people who use profit first, they hate paying taxes, but they love tax time because they know that no matter what the tax bill is, they can stroke a check. And they know that if they over saved for taxes, they get a tax bonus.
Yep. That's their profit, whatever's left over.
It's pure profit. So they're thrilled. So that's how the tax account goes. And then the last account was the operating expenses, which is your true spending account.
And there we go. So out of the operating expense account, you're going to pay for things like your payroll, buying equipment, office supplies, whatever other things are really operations for the actual company itself.
Correct. Now, there's a couple special scenarios, and there's a couple extra accounts. So some businesses have a very high pass-through cost, meaning, let's just say you have a cost of goods sold at 50%. Right? That's really high. Or let's say that you're in the construction business and you have subs that you're essentially billing for as part of your contract. So that money isn't really yours to begin with. If you've got that, what you want to do is keep a separate account right off the top to put that money in before you begin your allocations, because it's really not your money and it's already spent. So that's one thing to keep in mind. The other thing is some people like to save up for things. So you talked about equipment. Well, if you've got a lot of equipment and a high equipment turnover, let's say every year you've got to buy 10% of your revenue in equipment. Well, why not set aside an account, call it equipment replacement, and instead of putting it in OpEx, put it in equipment replacement. So when it comes time to replace equipment, you've always got the money there to do it. You start making decisions based on your values, not your bank balance.
I love it. That is a great phrase. Say it again, Rocky. Say it again. That was fantastic.
You make your decisions based on your values, not your bank balance.
What I love about it from that perspective is that you're making these decisions when you're logical, not related to emotion. So if you know, right, if you look at 5 years of history of your company and you've always had payroll costs of this amount, you've always had taxes within this percentage, you've always had equipment purchases of 10%, whatever that is, you are making logical choices at the beginning of the day rather than, oh my goodness, a piece of equipment broke and I don't have time to think about it, find a better discount or to do whatever, just buy it, just buy whatever you do. You're finding this when you're logical and you look at your equipment account, you say, great, we need a $100,000 tractor. We've got a $100,000 tractor. We're fine. We're good. So very cool. Okay.
So this is taking all the emotion out of it. You don't have to be an accountant. You don't have to look at financial reports. Your bank accounts give you true pictures of what's there. The biggest problem is some people steal from themselves. They steal from their profit. They steal from their pay. If that's you, then Mike sets up vault accounts. So if you're going to steal from your profit account, what he does is he sets up an account at a faraway bank that's really hard to get to. And he puts the money in that bank. And then he has like a counter person that has to like double sign his check so he can't steal from himself.
You have to sign in blood on the check. Very cool. Very cool.
He does that for his taxes too, because he knows he'll steal from himself.
Well, which makes the tax account makes sense, right? The one person you really don't want to get yourself messed up with is the mafia, right? The IRS, you really want to get yourself messed up with them. So let me ask you this, because one of the biggest complaints that I hear about using the profit first system is, this sounds great, this sounds fantastic, you're making it sound easy. However, 5 bank accounts, I'm going to forget which bank account is what, is tracking too much. My bookkeeper's pitching a fit at me because now she has to track 5 bank accounts, whatever. How do we, what do you say to people that say?
Okay, first thing, when you set up your bank accounts, you actually go into your bank account and you give them nicknames. And so the first account is called profit, and then you put 5% next to it. So you know how much to put in there.
Oh, so add the percentages, so it's real clear.
Yeah, so when you go to your bank, you go, oh, that's my profit account. I don't mess with that, and I put 5% in there, right? So if you think about this from an accounting standpoint, first of all your bookkeeper does is click a button on QuickBooks. It goes out to your bank. It grabs all these transactions. It's like 2 seconds of work. You're doing these allocations. Most companies do it on a twice-a-month rhythm, okay? So twice a month, you're going to go in there, and you're going to make 1 extra transaction to your profit account, 1 extra transaction to your pay account, 1 extra transaction to your tax account, and 1 extra transaction to your OpEx account. 4 entries. Whoop-de-frickin-doo-dah. Like, seriously.
Got it. I think, for a lot of people, to be honest with you, they don't have a simple explanation, right? So I have learned that people learn in different ways. Some people learn from reading, right? You held up the books, I think, at the beginning, or maybe we need to hold up the books, but basically some people learn from, thank you. Some people learn from reading, right? Some people find reading very confusing. So some people need a consultant, Rocky. Some people want, the guiding hand. Some people just need to hear it or to visually see it, see it actually on a spreadsheet or on their bank accounts, as you're saying, when you log in and see those bank accounts. So, okay, so learning in multiple different ways, hearing it multiple different times is a good thing. What other tips and tricks do you find make it easier for people to make this transition?
The transition isn't that difficult. Number one, communicate to your bookkeeper, your accountant, what you're doing and why. I can't tell you how many stories from accountants who fought them. And then 2 years later, they're like, oh, this is phenomenal. And then they start doing it in their business. And then they're like, oh my God, this
Telling
is
everybody.
I'm telling, and then they become a profit first professional, and then they go out and they start doing this because it finally clicks that this actually works and it's phenomenal. You just have to do it. Like it's like, I lost a lot of weight at one point in my life, and people would come up to me, they're like, "Are you okay?" Yeah, I don't have cancer. Life is good. That's what they all worry about, right? Then they're like, "What's the secret?" And then I would say, diet and exercise. And then that would end the conversation. Right.
Nobody wants to work hard. That's not happening. I love it.
But so think about it. If you went to the gym and you had a trainer, right? You would work out harder. You would get stuff done. If you came home and somebody had your meals prepared and portioned for you, you would eat well. It wouldn't be a lot of effort. You didn't have to think about it. You just showed up. It got done. That is essentially what I do for business owners. If this is a struggle for you, if you are not a numbers person, if this is not your natural gift, if it's something that, so there's another book because this book's hilarious. Accounting for the Number Phobic, right?
I don't think I've seen that.
Yeah. So she's actually a professor at my daughter's college. And so that's how I came to look at and find this. But here's the thing. Right? This is the beginning of the book. She said, here are what people who attended her workshop say about numbers. Makes me want to get in the fetal position and cry. I'd rather spend a weekend listening to my mother-in-law. Right? Some people are number phobic.
Definitely.
And if that's you, go find help. Right? Go find somebody to do this for you or to help you so that it gets done, because we can't ignore the numbers or we're screwed. So now I'm going to take this to the other end. Did you have a question before I do?
Yeah, well, it got a comment in my mind. Even if you think you're good with numbers, there's a trigger point here for me, right? If you think you're good with numbers, but every time you look at your profit and loss statement from your accountant and you're not making any profit, right? You're not, your bank account isn't getting bigger. You're not making any profit. You're not taking anything else home for all of the hard work that you're doing, all the blood, sweat, equity, and tears. You can be good at numbers, don't get me wrong, but the theory and the psychology of what we're talking about here may be something holding you back. So looking at something like the profit first system could be really good for you if you're not seeing any profit. If you're not taking anything home and you've spent years in your business and you're still losing money, time to look at this and see what's really going on. And I think there's kind of a big psychological scare to really see what's going on, right? Because if it's always hidden and I'm like, no, I'm just going to work harder, I'm just going to do it better, right? Well, this happens, right? And that's the mindset. I'm smart, I'm strong, I'm whatever, I should be able to figure this thing out. Listen, what's the definition of insanity? Doing the same thing over and over and over again. If you're looking at that profit loss every month, guys, or every year, okay, and you're still not making any profit, think about switching the system. Think about looking at other options on how you might actually be able to take home more than a stick of gum. Okay, so anyway, sorry.
So we have a mantra: profit is a habit, not an event. Right? It's something we build up to. It's not something that happens when we sell our business in 20 years or whatever. Profit is something that is all the time. Just from what I've seen, and even Mike says it in the book, 80% of business owners don't want to look at the numbers. It's not their thing. They have their own things that they love doing in their business. 80% don't want to look at numbers. Of the 20% that's left, 15% kind of have a clue, but they still like, there's 5% of business owners who truly understand their numbers and can crank it out and do it. So don't feel like you're alone. And that's just something that we talk about. And that kind of reminds me of another saying that I like to talk to business owners about. And it's the same numbers, actually. A lot of business owners think that $1 in revenue equals $1 in spending. And if you've got a 5% profit margin, you need $20 in revenue for each additional dollar you spend. And you need to keep that in mind. And if you did that, you're now on back to zero profit. So you really need to understand those relationships with money.
Love it. So, guys, I just want to take a quick little interlude here, guys. For anybody watching, for anybody that has questions, we can see and hear your questions. So please post them. We would absolutely love to answer questions live if we have time today. So definitely post questions. But yeah, Rocky, go ahead, please.
So I'm going to bring up another book. As you know, I love books. This one is by Jonathan Burns. He's an MIT professor, and he talks about islands of profit in a sea of red ink. So he actually did studies, and he looked at large corporations. So we're talking about big companies. He said 40% of their sales are unprofitable.
40%.
Yeah, 40%. 40. He went across a multitude of companies. There's a paper written on this, right? He comes from MIT. He knows what he's talking about. 20% of what they sell is highly profitable. The rest is
80-20 rule.
80-20 rule. The rest is break even. The problem is nobody knows which 20% is highly profitable. The accounting systems don't necessarily track profit at that level. On top of that, if you're the general manager of an unprofitable division, you're not raising your hand going, hey, we're unprofitable. We're costing the company all its profit.
Oh, gracious.
Oh, yeah. And so most companies don't have the ability to see that. It could be a mispricing.
Yeah.
It could be that they just didn't happen to notice because most people are looking at the top line. Yep. Nobody's digging in to each of the line items and the revenue and so forth. Like my customers who are on Shopify, I go into Shopify, I go, show me profit down to the line item by SKU. And I'm like, you had a big sale this weekend. Well, exactly. And I said, you had a big sale this weekend. Guess what happened?
Oh no, you lost money.
Mm-hmm. Oh. That happens, right? 30% off the website. And the next thing you know, you're losing money.
And there you go. And here you are thinking you're bringing cash in the door. That better be old inventory that you're trying to get rid of. That's all I have to say.
Well, they're doing that because they got bills to pay next week. I need to get cash in the door. Let's have a sale. Yep. And so we get stuck in this cycle. And so it's knowing that. And the other thing is, depending on the type of company, you might have a lot of inputs that go into that sale. And so do you know what all those inputs are? And are you measuring them? Another thing might be, do you have, so we were just on with one of the clients today, and they're like, small jobs kill you. So think about it. If you're in the trades and you've got sub $1,000 jobs, they might suck up all your time and barely give you much profit, where your $30,000 job is highly profitable. So do you take the time to say, guess what? We don't service sub $1,000 customers. Like that's.
For anybody that knows me, that has seen anything I've ever done, I love Tim Ferriss. I am all about the 4-hour work week. I'm all about one of the things that he covers in detail. I think there's an entire chapter just on Tim Ferriss's theory on this, right? Is that you're just pulling it off your shelf? I'm loving your bookshelf, Rocky. This is amazing.
There it is.
One of the things that Ferriss covers is, looking at your client base and looking at what you're selling and the profit per item and how much time, how much resource, how much whatever is getting sucked up in this. And effectively, you don't even have to just completely ditch your clients. Sell those clients to somebody who wants the $1,000 an hour jobs. Create a partnership, create a stream of revenue, right? If you get a referral, send it to that person. You don't want to be messing around with this stuff. Why bother? So anyway, didn't mean to make a rant, but yes, it just speaks right to it. And if you have nobody on your team looking at the numbers and looking at that analysis, okay, that's where I think business owners just run into so much trouble, right? Because they dig their head in the sand and they say, I'm going to just work harder. Who needs sleep? I'll sleep when I'm dead, right? Yeah, sleep is good. Sleep should probably be in that pay to owner category. Is like some sleep might be good. So sorry, Rocky, go ahead.
Well, no, and that happens. So like I had someone on my podcast and he was in the landscaping business, right? And he said when it came to laying mulch, we looked around at the market and the market said this is how much you charge for laying mulch. So he said that's how much I charge. These people must all know what they're doing. Then after a while, he said, wait a minute, let me actually run the numbers. And he realized, hey, at these numbers, it doesn't make sense to lay mulch. It's costing me more money. So he doubled his prices because that was what he needed to make to reasonably do that. And his customers are like, well, that's a lot to lay mulch. I can lay it myself. And he's like, you're right.
Have at it.
You have at it. Go to the store, pick up 50 bags, spend your entire thing out here in 100 degrees.
Yep.
Go for it. And they'd be like, yeah, no, thanks.
Here's the check. Here's the check.
Here's a check.
So we actually have a question. Thank you so much, Chuck, for writing in. So Chuck wants you to go over in detail. So for a 5% profit, we need to generate an additional $20. Can you please go over that in detail? Can you run through that a little bit more?
Yeah. So that was based on a company that has a 5% profit margin, which means we get $100 in revenue. Out of that $100 in revenue, we have a cost of goods, right? There's all the stuff all the materials that went into selling that $100 item. So I'm just going to make up numbers here. Let's say that was $50. So we've got $50 in all the materials to deliver that service. Well, now you have employees, right?
Right.
And you had to put time and effort. There's admin, there's billing, there's this and that. Maybe that's $20, right? So now that's $70. You've got overhead, right?
And
insurance, all those things. And so that represents a certain portion of it. So when you add up all these things and you say, generally, when I sell something for $100, my profit percentage is 5%. That means I get $5. So when somebody comes to you and says, hey, I've got this super neat product we'll 10X your business. Your first answer is, well, wait a minute. If I 10X my business, I'm losing money. I need to 20X my business to get that same return for what you're charging me for all of this stuff. And a lot of times this happens in the world of marketing. Right? The people in the world of marketing say, hey, if you could spend $1 and get $1.50 back, you'd be happy, wouldn't you? You'd just keep putting the dollar in to get $1.50 back. What they forget is every time you're giving them $1 and you're getting 50 cents back, you still have to run your company on the 50 cents. And the reality is it's costing you $1 to run the company. And so now you're losing 50 cents. Does that make sense? I know it's kind of hard to get these numbers wrapped around it. And that's why I think everyone struggles. But there's the cost of doing business, and everyone forgets that an additional sale has all these costs associated with it. And they forget about that. That's really what we're talking about. So if you're going to go start spending money, you have to ask yourself, am I going to get enough of a return to be profitable? Or am I on that hamster wheel of selling something and then all the inputs that go into it, and I don't get anything at the end of the day?
So let me repeat it back. Let me see if I got it. Because if I didn't get it, nobody else got it either. Let's try it out. Okay. So I sell something for $100, right? After all of my everything, right? After all my expenses, I get to keep my profit is $5. Okay. So basically what you're saying is that in order for me to make another 100, right? If I spend that $5 on advertising, I really have to be making 100 times, right? Enough so that after my expense, I'm still netting 5%.
Correct. So if you spend that $5 on advertising, right, you need to sell $100 to make the $5 back.
Right.
So that's where that 20X comes in. I think that's a lot easier to understand.
I think that's
because
so
if
in and the 20%
right
all these times. Okay, so
yes.
It's really about just making sure that if you as an owner want 5% profit, 10% profit, whatever it is, once you know what that number is, you now know how much your money has to return to be able to still get 10, 20, whatever that percentage is.
Correct. And it comes down to the simple way of saying $1 in revenue does not equal $1 in spending. Right. And everyone's got their own particular percentage for what that is.
For sure. Okay. Thank you, Rocky. I think that helps a ton. So, okay, keep going. Let's keep going.
So we've covered a lot. We've talked. So let's talk about vanity spending.
Yes. So vanity is your income account.
Well, that is your sales are vanity, but then there's there's vanity spending. So vanity spending is, I need a fancy office, right? I need a fancy building. Do your customers care if you're in a fancy building? Do they care that you pressure wash their house in that brand new Ford F-150 with, super brand new stuff? I think too often we spend because we're like, "Ooh, that's cool. I need that." And that's a big part of what too many businesses do. And then there's forgetful spending, right? We signed up for all these services and we don't use them anymore. Did anybody bother to cancel them? Yeah.
Yep.
Did anyone bother to cancel them? Have you ever bothered your customers negotiate with you? Do you negotiate with your suppliers, your vendors? Do you call up the phone company and go, "Hey, you're charging me too much"? So we're not on Zoom. We're on StreamYard. But it's funny because I was having this conversation with a guy early on, and he was bitching about the cost of Zoom. He'd been on Zoom for years.
Yeah.
And we're all like, "What are you talking about?" And he was on a grandfathered plan that was charging him, 3.5 times what everybody else was paying on the new plan.
Oh, no.
He never bothered to call and say, "Hey, is there a better plan?" I can't tell you.
Zoom's not going to call him and be like, "Hey, we've got cheaper plans." That's not happening.
No. And I'll be honest, cell phone companies constantly come out with better deals. The cable company comes out with better deals. Your vendors, call them up and say, "Hey, I know we're doing this. Is there a better, less expensive way to do this? Is something changed?"
People hear about this. The most common place people hear about this is calling your credit cards to ask for a lower rate or a better term or whatever, right? But I'm with you. I don't think a lot of people think about, you just think about, that's my cell phone bill, and it's always been my cell phone bill, and why would I look at it, right? But just making something as simple as a telephone call, and I've seen it, I'm sure you've seen it a million times. You make a telephone call, they'll cut your rates from $60 a month to $15 a month because your grandfathered plan, who cares if you're grandfathering anymore? I mean, if you don't need that plan, who cares? So. No,
and I do that. I think earlier this year, I emailed my insurance agent, "Anything we can do to lower insurance?" I got an email back like a day later. "Yeah, we cut your insurance $300, no change in anything." I'm like, well, that was a cool $300 for 2 minutes.
Yeah. So, and sorry to go off on a little bit of a tangent, here, a lot of people, especially business owners, if you're a single business owner, right, it's you. You don't have an assistant, you don't have any help, you don't have, any way to do this, right? And you're not sleeping and you're not making any profit, you're working 24/7, right? Realize that there are services that you can actually call the service and have them help you with this, right? Where you give them a list of, here's all my vendors. They'll sit on the phone, they'll sit on hold. As soon as they get a representative and they've worked out the deal, then they call you and tie you in and say, "Yes, I approve of whatever the change is, go," right? So there's a lot of really cool things you can do. It doesn't have to be you, right? So anyway, sorry.
Well, and I think that should be one of the mantras for businesses is who, not how, right? Not that you have to do everything, delegate. And you can delegate out to freelancers. You can delegate out my virtual assistants in the Philippines.
I was going to say, you're preaching to the choir. We've got India, Kenya, Uganda, the Philippines. So, yeah.
There are ways to do things. So that requires you to create the space to think and work on your business instead of in your business. And that's what all of this comes down to is create the space, open it up a little bit. And you won't be, if you're working 24 hours a day, you're the problem. You need to change you to start working 8 hours a day appropriately and getting things done. And I think that's kind of the reflection in the mirror. of being able to do that. It's tough. We get stuck. It's hard. That's why the numbers part is hard, because you get a business and they get up to $1 million in revenue and they're still struggling and they're embarrassed because they're like, how is it that I can grow this business to $1 million and I don't understand the numbers, and their account goes wonk, 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 wonk in words they can't understand, won't explain anything. And what do? And that's what happens. So you've got to find the right group and the people to help you do this, but you can.
Sorry, go ahead.
No, that was it.
Well, I was just going to say, guys, Tax Goddess, and I'm 99.99% sure that Rocky Lalvani is the same way. This is a no judgment zone, okay? Please don't be embarrassed. Please don't be embarrassed, right? Because if you don't ask for help, if you don't reach out, if you don't ask questions, guys, we have Rocky for another, 20 minutes. Maybe if we're lucky, we'll have Rocky for another 20 minutes. So if you guys have questions, please post them. Please, please, please post those questions. And give us some love, give us some thumbs up and some likes and all those other good social media things. But, guys, don't ever be embarrassed. Please don't ever be embarrassed, because if you don't ask, you'll never know. You're going to keep being in that same cycle. And it's just dangerous. It can lead to some really bad places for you, for your business, for all sorts of things. So, yeah.
So I tell people they're the business owner, they're in charge. If someone's bringing you information in a way that is not clear and that you can't understand, you tell them to either bring it to you in a way that you can or fire them, right?
There is somebody else who can bring you that information in a way you understand. That's brilliant.
Yeah. And I think you were talking earlier about different learning styles. I think for most business owners, having things presented to them in a graph makes it easy for them to understand. I show you a graph of your sales. You can look at that and go, sales are going up. Good. Sales are going down. Bad. Right? If you see your expenses in a graph, expenses going up. Bad. Right? Expenses going down. Good.
Yeah.
Right? Accounts receivable going up. Bad.
Yep.
So if you see these things in a graphical form where you're comparing one period versus another period monthly, it doesn't take rocket science to do this. This stuff is all second, third grade math. It's not complicated. But unfortunately, everyone's taught math is hard and math isn't their favorite subject. And so there's a lot of emotional baggage that comes along with this. And I get that. That's why, I try to make it easy on my clients and make sure that they understand what's going on in a comfortable environment. And as you said, there's no judgment. Like, it's your money. You want to make silly mistakes, I will point them out to you and say, it's your choice.
Yep.
You make it once, okay. You make it twice, now it's a problem. If you're doing it consistently, well, now you've got no one to blame but yourself. And so that's your choice on how you do it. But this stuff isn't as difficult as I think people make it out to be. And accountants use all these big words and big labels and
talking tax talk or tax code or whatever accounting code. Got it.
Debits and credits. Who wants to talk debits and credits?
How dare you bring that up on the podcast? Evil man. Okay. So Rocky, let's go over this again, because I know now we've been on for 43 minutes. And for those of you that have stuck with us through this entire presentation, let's go back to the beginning here, right? Okay. We have 5 accounts: money coming in, profit to the owner, wages and or benefits to the owner, right? Taxes, mafia, taxman, the evil dark side, whatever you want to call it. Okay. By the way, side note for that particular account, my favorite label is to say the IRS, because if you take out the space, it spells theirs, and then it's their money. Side note, that's for account 4. And account 5, of course, is for all of your other remaining expenses. Now, so all right, I've listened to this event today, Rocky. I am super pumped about this. Now what? What do I do? What's my first step?
Go open up the 4 additional accounts.
Okay. So I've got my primary where my money's being deposited. Yep. Just go open the other 4. Okay.
Go open the other 4. Ask yourself, what is easier? Okay. A lot of people have automated stuff coming in and out of their main account. is it easier to move the incoming or the outgoing? So if you say to me, well, I've got all these automated things coming out of my account, it's easier for me to move the automated incoming. Or is it, so figure out which one's easier to move. One of that account that you have currently either becomes the income account or the expense account. Just whichever one makes more sense to easily do it.
So if you're talking about like my cell phone bill is coming out, my insurance is coming out, like you do not want to be calling 40, 50 vendors, other than the fact that you should, and you should ask them if there's a discount applicable.
Yeah.
Anyway, but really, so you're saying take your original account and instead of making that your income account, make that your expense account because that's where all the money's coming out.
Correct. The next thing we need to do is we need to figure out the percentages that go to each account. And we're going to do this off of historicals. So one of the simplest ways to do this is just go to your last year's tax return, right? You see the top line revenue. You know how much you got paid. What percentage is that, right? You know the profit at the bottom line. What percentage was that? You know how much you paid in taxes. What percentage was that? Now we're done. Now you have your percentages. Go in and label the accounts, income account, profit account, whatever percentage it is, your owner's comp, whatever percentage it is, and then come up with a schedule. Most businesses are going to do it twice a month. Mike recommends the 10th and the 25th.
Is there any particular reason for the 10th? Like why?
I think a lot of stuff tends to be due around the 15th and the 30th, right? Or the 1st. And so
there.
Yeah, it allows you to kind of be ahead of that, I think. And so then you sit down and you look at your income account, how much money is in it. I see that. Move the appropriate percentages to each of the accounts, round it off. You don't need to be worrying about pennies and just round the whole thing off, right?
Okay.
And then move the money.
Okay.
And then, so that's how you get the rhythm started. Now, what's going to happen in the beginning is you're going to have struggles because there's not going to be enough money in the OPEX account. And so what you're going to start doing then is asking yourself, how do I cut costs? How do I stop spending so much? How do I live in my constraints?
Okay.
And so that's going to happen. And then slowly we're going to get our OPEX under control. Once we've done that, 3 months from now, we're going to tweak the dials. We're going to turn profit up maybe 1%. We're going to turn up our pay 1%, and we're going to turn down operating expenses 2%. And then we're going to go for 3 months. And we're going to
that re-edit, that re-review like once a quarter, basically.
Once a quarter, yes. Now, at the end of every quarter, you have a whole bunch of money in your profit account. It's time to act like a big company. Take half of the money that is in that account and distribute it to you as your profit distribution check from the company.
Okay.
Once you get your profit distribution check, you can use some of it to go splurge and celebrate your hard work.
Okay.
If you're in debt, pay down your debt.
Okay.
If you're not in those situations, and set money aside for retirement, for something else, to buy a second company, to invest in real estate, to whatever you want to do outside of your company.
So you could actually use the profit first system then on both ends of that, right? So here's my business profit first with my accounts. Here's my personal profit first, because my bonus and my bonus and my wages for my business account would go to potentially my personal account. So then I'm doing exactly the same thing on the personal side super cool. Okay.
And it works on you. This is the reason I'm a multimillionaire, because I implemented this system. How old am I? 35 years ago, something like that. I don't 30 years. Yeah. I implemented this 30 years ago. And so it works because compounding works magically. And that's another principle that we talk about. And little things, little changes compound over time. And in the book, Mike has a chart that shows you what your target should be based on the size of your business. And so your goal is to get from where you are to where the targets are. And we try to do it in 2 years. So this is not, don't try and do it tomorrow. You will blow up, right? Try and do, you can't gain 50 pounds and then say, oh, I'm going to lose it all tomorrow, right? It takes time. So I usually tell people 2 years to get from where you are to where you want to be financially.
Very cool.
And then you just keep taking those steps and little by little, it is amazing how things compound and how things will work over time.
Love it. Love it.
Question, has anyone covered compound interest and the compounding principles on your show?
I don't think so. How about it?
All
We've got
right,
10
so
minutes left. Let's call it 9.5.
Okay.
How about
So, Shauna, you've got a new client, me. I'm hiring you on January 1st.
Okay.
I'm going to hire you for 31 days.
Okay.
I've got 2 offers for how I'm going to pay you.
Okay.
I'm going to pay you $100,000 a day for 31 days.
$100,000 a day for 31 days. Okay.
Yeah. So what is that for the 31 days?
1 million.
Yeah, exactly. Very good with math. Here's the other payment plan.
Okay.
On January 1st, I'm going to pay you a penny.
Okay.
January 2nd, I'm going to double it and pay you 2 pennies.
Okay.
January 3rd, I'm going to double it and pay you 4 pennies.
Okay.
January 5th, I'm going to double it and pay you 8 pennies all the way through to the 31 days.
Okay.
How would you like to get paid?
I need a calculator. Let me figure that out. I feel like I've heard this riddle before, but tell me.
So how much do you think the penny doubling ends up on the 31st day? Throw out a number.
10 million.
You're halfway there.
Okay.
It's almost $21.5 million.
Really?
Yes. And here's what gets interesting, right? So at the end of 7 days, with the pennies, you get $1.27, which is really exciting. At the end of 14 days, you get about $164. So even then, it doesn't seem like much, right?
Yeah.
Day 21, we're at $21,000. Woohoo. But what happens is when you look at day 28, the two kind of get very close to each other. But if you think about it, if I'm at 2.7 million on day 28, the next day I go to 5.4 million. The next day I go to 10 million and change, and then I get to 21 million. It's the power of constantly showing up and keep going and letting that process grow. And I always tell the story of an airplane taking off because this is how business owners think, right? We're heading down the runway. The airplane's doing 100 miles an hour. Engines are full speed. It's shaking like this, right? You look out the window, you go, I'm freaking on the ground, right? But you know what happens next. If you keep going, right, you essentially take off and you soar. Too many people give up in that dip. And if you give up in that dip, so if you give up at day 14 and you've got $164 and you start over, where are you at day 28? You're at $320 and you're wondering why you're grinding it out. So take the time to figure out the skills, the processes, the things that you need to build on. Don't look over there and go, hey, Shauna's at day 14 with 1.4 million bucks. Look at that. I'm sitting here with so little. You're building a much better, stronger tunnel vision business. If you look at Amazon followed those principles, right? Uber, on the other hand, follows a whole different principle. They don't know what the word profit means. It doesn't show up on their meetings. Nobody talks about it.
Different thing.
Who thought about that? Yeah. But it takes time to do these things. Build the principle. So if you think about that little bit of doubling, we talked about starting with a profit account with 1%. So I'll make this simple, right? We got 6 minutes left. Your clients are like, I'm overwhelmed from listening to this. I can't do all of this. Just do this one thing. Go make one account, label it profit, and every month just take 1% of your revenue and put it in that account. At the end of 3 months, look at it and go, that's money I would have blown without noticing. Now let's make it 2%, right? And if every quarter you just increase by 1%, kind of like that penny, think about what's going to happen over time. Over a couple years, you will start to build a profitable business. You will never miss $1 out of 100, right? Because
that was the Starbucks that you didn't drink in one day. There's your $7 right there.
You missed it. So that's the big part of it is these principles are all universal principles. They work in your personal life. They work in your business life. They work when it comes to weight gain and weight loss. It's all the same thing. And so just go take a little bit of action and then just get a little bit better. And then take a little more action and get just a little bit better. And it's going to take time. But over time, you will find success. And the reality is no one's going to offer you $100,000 a day for 31 days. So you're never getting that deal.
Oh, damn. I love it. Rocky, this has been just such an amazing pleasure. You are so knowledgeable, and thank you so much for coming on Tax Goddess Live and speaking to our people. We're so happy to have you. In the last few minutes, guys, if you have any questions, we've got 4 minutes left, so now's the time to ask if you have any questions whatsoever. But Rocky, in these last 4 minutes, what is the most important takeaway? I love the start with one account, start small, right? You can always add more if you want to. Don't freak yourself out. What is if you were going to say one thing, what's the one thing?
Do it.
Love it. Where's Nikki? Where's your endorsement? I love it. Just do it. I love it.
You have to take action. You just have to do it. And it's okay if you start with a penny, right? Because look at what the power of the penny is. That's why I tell that story. Little bits of action will compound over time and you will build wealth. It works. It's proven.
Oh, Rocky, this has been such a pleasure. And guys, of course, if you have any questions, Rocky, tell us, how do people find you?
So if you want to learn more about the Profit First system and that, I have a podcast called Profit Answer Man. And so that's where we talk all about Profit First and how to implement. And then for those of you who've kind of figured out the money and you really want to live life, I have another podcast called Richer Soul, which is about living life of abundance and how do we create the rest of the systems? How do we use that money to live the life we truly want to live?
That's so cool. I hope we had 4,000 people just swarm your podcast. That would be lovely. And guys, what we will do, we will ask Rocky, we'll get it from his marketing team to grab all of his links and get them posted all over the place. So it's easy for you guys to find. But Rocky, give us those names one more time.
Podcast is Profit Answer Man. So if you just put that in, it'll pop up, or you can profitanswerman.com. And then the other one is Richer Soul. And again, if you Google them, if you Google my name, all of this stuff will pop up. You'll have pages of me. I rank on Google. I think I'm like the first 8 pages.
I love it. All right. Well, so if you're looking for 8 pages of Google reading, Google Rocky Lalvani. Rocky, this has, again, been such an absolute pleasure. Thank you so much. Guys, if you have any questions, go Google Rocky and pick one of his 8 pages of listings on Google. So, Rocky, anything else to say before we shut down for today?
No, I think people just need to go take action, take that little teeny step and keep doing it. I know you guys can do this. Entrepreneurs are smart. They're resourceful. You don't need more resources. You need to be more resourceful. And I know you are.
Love it. Perfect way to end the broadcast. Thank you, Rocky, so much for your time. It's been a pleasure.
Thank you, Shauna. It was great to be here.